This video provides an overview of the major concepts covered in Chapter 22, Finance Company Operations. Finance companies provide short and intermediate-term credit to consumers and small businesses. Consumer finance operations can be conducted by independent finance companies or by subsidiaries of financial conglomerates. Chapter 22 includes 5 key concepts, which include the main types of finance companies, the main sources and uses of finance company funds, factors that determine the values of finance companies exposure to various forms of risk, and multinational finance companies. Let's begin with the types of finance companies. Finance companies are often classified according to the specific services they offer. Consumer finance companies provide financing for customers of retail stores or wholesalers. For example, a consumer finance company may sponsor a credit card for a retailer so it can offer its own credit card to customers. While most consumer finance companies also provide loans directly to individuals to finance purchases of automobiles and other large household items, some consumer finance companies also provide mortgage loans. Business finance companies offer loans to small businesses. For example, they may provide loans to finance inventory costs. Business finance companies also provide financing in the form of credit cards that are used by businesses and employees for travel or making purchases on behalf of the business. A captive finance subsidiary, or CFS, sometimes called a captive finance company, is a wholly owned subsidiary whose primary purpose is to finance sales or leases of the parent company's products and services, provide wholesale financing to the distributors of the parent company's products, and purchase receivables of the parent company. Finance company loans are subject to ceiling interest rates and a maximum maturity. State regulations also require finance companies that are planning to expand by establishing branches across state lines to justify how the planned branch would serve the needs of the people in that location. In addition, finance companies generally must comply with the federal statutes governing equal credit opportunity, proper disclosure, and truth in lending, as well as the Financial Reform Act of 2010's prohibition against deceptive and unfair practices. The next concept relates to sources and uses of funds for finance companies. Finance companies are distinctly different from commercial banks and savings institutions in that they don't rely heavily on deposits. Finance companies commonly borrow from commercial banks and consistently renew these loans over time. Although commercial paper is available only for short-term financing, finance companies can continually roll over their issues to create a permanent source of funds. Under certain conditions, some states allow finance companies to attract funds by offering consumer deposit services similar to those provided by depository institutions. Finance companies in need of long-term funds can issue bonds. When the company's assets are less interest rate sensitive than its liabilities, and when interest rates are expected to increase, bonds can provide long-term financing at a rate that's completely insulated from rising market rates. Finance companies can build their capital base by retaining earnings or by issuing stock and engaging in initial public offers. Like other financial institutions, these companies maintain a low level of capital as a percentage of their total assets. One of the main uses for financing companies is consumer loans, which include automobile loans, personal loans for home improvement, mobile homes, and other personal expenses, and credit card loans through retailers. In addition to consumer loans, finance companies provide business or commercial loans, often backed by inventory or accounts receivable, to help businesses cover the span from when they purchase raw materials until they generate cash from sales of finished goods. Some finance companies provide loans to support leveraged buyouts or LBOs. These loans are generally riskier than other business loans but offer higher expected returns. Finance companies commonly act as factors for accounts receivable. That is, they purchase a firm's receivables at a discount and are responsible for processing and collecting the balances of these accounts. Another way financing companies provide financing is by leasing. For example, they may purchase machinery or equipment and then lease it to businesses that prefer to avoid the additional debt on their balance sheet that purchases would require. Finance companies offer real estate loans in the form of mortgages on commercial real estate and second mortgages on residential real estate, which are typically secured and historically have had relatively low default rates. The particular allocation of a finance company's uses of funds depends on whether the company is focused on business or consumer lending. This exhibit summarizes the sources and uses of funds and illustrates how finance companies finance economic growth by channeling funds from institutional investors who purchase the securities they issue to households and small businesses that need the funds. When finance companies obtain or use funds, they interact with other financial institutions as summarized in this exhibit. Because of their concentration in consumer lending, finance companies compete with commercial banks, savings institutions, and credit unions. Finance companies with subsidiaries that specialize in other financial services also compete with insurance companies and pension plans. Finance companies utilize various financial markets to manage their operations, as summarized in this exhibit. For their core business, these companies commonly rely on money markets via commercial paper and bond markets to obtain funds. The insurance subsidiaries of finance companies often utilize bond and stock markets to invest funds and also use futures, options, and swap markets to hedge the risk of their investments. Now let's look at how finance companies are valued. Just like commercial banks and savings institutions, finance companies, or consumer finance subsidiaries of financial conglomerates, are commonly valued by their managers to evaluate their progress over time or by financial institutions that are considering an acquisition of the finance company. Like banks and savings institutions, the value of a finance company is the present value of its expected future cash flows. Thus, the value of a finance company should change in response to changes in its expected cash flows and changes in the required rate of return by investors. The same factors that affect the cash flows of commercial banks and savings institutions apply to financing companies as well. The change in a finance company's expected cash flows is a function of changes in economic growth, the risk-free interest rate, industry conditions such as regulatory constraints, and the abilities of the finance company's management. As we saw with commercial banks and savings institutions, the required rate of return by investors who invest in finance companies is a function of the risk-free interest rate and the risk premium. The risk-free interest rate is usually expected to be positively related to inflation, economic growth, and the budget deficit, but inversely related to the Fed's expansionary monetary policy. The risk premium on a finance company is inversely related to economic growth because uncertainty about loan repayments declines when economic conditions are strong. The risk premium is also inversely related to the company's management skills, as more skillful managers may be able to focus on financial services that reduce the finance company's exposure to risk. This exhibit provides a framework for valuing a finance company. In general, the value of a finance company is favorably affected by strong economic growth, a reduction in interest rates, and skill management. The sensitivity of a finance company's value to these conditions depends on its own characteristics. The higher the risk tolerance reflected in the loans provided by a finance company, the more sensitive its valuation will be to changes in economic growth, and therefore to changes in the ability of owners to repay their loans. The next major concept relates to the exposure of finance companies to risk. Finance companies, like other financial institutions, are exposed to three types of risk. Finance companies generally don't hold many assets that can be easily sold in the secondary market. So if they need funds, they've got to borrow. Their balance sheet structure doesn't call for much liquidity because almost all of their funds come from borrowings rather than deposits. Consequently, these companies are not susceptible to unexpected deposit withdrawals. So overall, finance companies have less liquidity risk compared to other financial institutions. Both the liability and asset maturities of finance companies are short or intermediate term in duration, and therefore not as susceptible to increasing interest rates as those savings institutions that offer fixed-rate mortgage loans. Even so, finance companies can be adversely affected by rising interest rates because their assets are typically not as rate sensitive as their liabilities. They can shorten their average asset life or make greater use of adjustable rates if they wish to reduce their interest rate risk. Because the majority of a finance company's funds are allocated as loans to consumers and businesses, credit risk is a major concern. Customers who borrow from finance companies usually exhibit a moderate degree of risk. Although the loan delinquency rate of finance companies is typically higher than that of other lending financial institutions, this higher default level may be more than offset by the higher average rate they charge on their loans. Many finance companies provide subprime auto loans, which are made to people with low credit scores and poor credit histories. Like mortgages, auto loans can be securitized, meaning that they are bundled together and sold as a package. Although some critics have expressed concern about the increase in this subprime debt, securitized auto loans tend to receive high ratings because people need their cars to get to work, so they'll pay their auto loans even if they can't afford to make payments on other debt. The last concept deserving brief mention in the chapter is multinational finance companies. Some finance companies are large, multinational corporations with subsidiaries in several countries. For example, GM Financial provides auto loan services in North America, Latin America, Europe, and Asia. It provides products and services in local currencies where it does business.